Good afternoon and welcome to Market Sector Analysis. To end out this week, it's another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach here with Charles Schwab. I'm joined by my good friend Cameron May out there in the chat. Cameron's going to be helping out to answer your questions along the way, facilitate the conversation, and we're glad that all of you are here with us as well. At the end of the week, the market's not done yet. We've got a little bit of time left in the market for this week, but some investors might be wondering, why bother at this point? Because it has been an interesting week. It has been a challenging week, perhaps, for a number of investors who have become accustomed, perhaps, to more bullish activity. So we'll take a look at that. We'll take a look at perhaps the idea that there's a little bit of rotation going on, perhaps more so than retreat in the market. And we will walk through a couple of things. Plus, it is another national day that we need to pay attention to, as well as it always is on Friday. There's always a national day of some sort or another that we'll talk about. But before we do that, a couple of quick reminders. Remember, everything that we talk about is simply for illustrative and educational purposes only, not any kind of a recommendation or advice or recommendation or endorsement or anything else. All of the examples that we will look at are simply for illustrative and educational purposes only. Remember that we're going to use some technical analysis in this discussion, but Schwab doesn't recommend the use of technical analysis as a sole means of investment research. There are other ways of looking at the market, whether it's fundamental analysis, probability analysis, technical analysis, for that matter. They are all theoretical in nature. None of those are guaranteed, and none of those guarantee what the market will do. We're going to be using the thinkorswim desktop software platform today, specifically the paperMoney version of that platform. The paperMoney version of the platform, great learning environment, not a guarantee of future success. Also, pay attention to this disclaimer. There are certain things that the paperMoney account does not do that a live account will do. One of those is it doesn't facilitate the early assignment of short options. Two, the other thing that it doesn't do primarily is that it does not allow for the use of scripted studies or studies in scans. So that's something to pay attention to as you move your activity and practice from paper trading to live trading. There are some differences between those two. Now, we're going to look at a couple of different futures symbols in this discussion today. We're going to be using those as measurements of the market and not as tradable instruments. However, I teach a trading futures webcast on Tuesday mornings. Remember that futures and futures options trading involves substantial risk. It's not suitable for all investors. Make sure that you understand the characteristics and risks of those products. And remember that it takes separate trading authorization. So we're not going to be talking about the futures contracts here as tradable instruments, just as market measures. And that would include any futures instruments that also focus on things like virtual currencies, cryptocurrencies, and others. Remember that those have their own unique risks, so be aware of those. And we'll talk about those as we get into this discussion. Remember, past performance, no guarantee of future results. So let's jump into what's going on here today, first and foremost. I'm going to come back over here to the thinkorswim desktop software platform paperMoney account, and we're going to take a look at what's been going on over the course of this week in the indexes. And again, Cameron's there to help facilitate any questions you might have. If you're watching this in the recorded version, by all means, leave us a comment, and we will get back to that comment as quickly as possible. So speaking of as quickly as possible, the market moved back up again as quickly as potentially possible off of a big gap down this morning, and really kind of a continuation of some downward movement. If we take a look over here on the right-hand side, and we zoom in a little bit here on the SPX, this is the S&P 500 index. And by the way, I teach an index trading option or trading index options webcast on Wednesday afternoons, where we talk about using the options on these indexes as tradable instruments. But it has been kind of a mixed bag over the course of this week. So here was last Friday, and gosh, you know, for all intents and purposes, we are back to the same point that we were in last Friday with this movement right off of that 50-period simple moving average in the index. We saw a little bit of a rally higher. Now, okay, and I've been seeing these comments in the chat all week. I've been seeing these comments in social media. By the way, you can follow us on social media. Cameron has posted those social media handles, both his and mine. Other coaches are similar. You can follow me and Cameron on X. You can follow us on LinkedIn. He's posted those to the top of the chat. But I've been watching these comments over the last couple of days, and it's really kind of been an interesting mix of commentary about just the pure technicals of this market. Now, we've got the 50-period moving average here. I'm just going to draw some lines here, and I'm going to draw those lines in such a way that I'm just touching on the lows here off of these last two candles, last week and this week. And what I want you to look at is this particular line right here, the line that I just drew across the bottom. And now what I'm going to do is I'm going to put my horizontal crosshair so that it intersects with the starting point of this line right here. And I'm going to put the end of that crosshair right there on the terminus of that line. And I just want you to tell me just so you've got something to reference, so you can zoom in on this. So you've got something to reference here. What is the directional trend of that line that I've drawn here? Because there's some confusion amongst investors, at least according to some of the comments that I've seen. I think the unique aspect of that trend line that I drew in there is that it is pointed up. Now, I drew it off of the lows, which means that those lows that we've seen over the last week, the last 2 weeks, the last 3 weeks, the last 5 weeks here are still getting higher. We do not have a lower low yet in the context of this intermediate term uptrend. So what that suggests is that there is still some buy the dip mentality going on, because every time it gets down near this 50-period moving average, there's buying activity that happens. 2, that the trend is still intact, and we may simply be in a pause or a consolidation time frame. Now, to clarify for everybody else, for all the other comments that I've heard and seen the course of this week, if you look at the trend line that I put up on top, now this is just as relevant. I drew that trend line to those highs. So I'm going to put my intersection at the beginning of that line, at that previous high. I'm going to put the end of this crosshair right here at the terminus of that upper trend line, the one on top of this pattern. Tell me what the trend of that line is as you look at that, because it seems to be pretty clear to me from a technical analysis perspective that that trend line is moving lower. So what that suggests is over the course of the last 3 or 4 weeks, we've been establishing a series of lower highs. Lower highs, higher lows gets us into a squeeze. It gets us into a consolidation. So if this market, the SPX, is squeezing, right? And that's kind of what we're looking at. Let me do a couple of things here real quick. I'm going to go to my gear icon. I'm going to go to my price axis, and I'm going to make sure that I've got this kind of squared away so that we can see it. And I'll kind of bring this down a little bit. I'll see if we can kind of make these candles a little bit larger. That probably makes it a little bit easier to see in terms of the trajectory of these two lines. So we're making lower highs and we're making higher lows. And when we make lower highs and higher lows, that's consolidation. That's not trend change. That's simply a pause. That's sideways movement. That is not a trend change. And neither is this lower high indicative of or guarantee of a potential reversal. It is very simply consolidation. Now, we're seeing a little bit of a pullback in terms of RSI. And I don't mean to be pedantic about this. And by the way, Cameron May, who's out there in the chat, does a great job. He's gone through the entire series a couple of times of getting started with technical analysis and understanding trend. And he also teaches on Fridays advanced charting techniques. And I know he does a lot of different technical indicators. One of those is, looking at moving averages. One of those is using trend lines and things like that. So having a clear understanding of these types of price patterns, by the way, we've got a couple of different webcasts that talk about price patterns. This is a squeeze. This is a symmetrical triangle, nothing more, nothing less. So from a technical perspective, we might say, all right, cool. We're just pausing at this particular point. And the idea would be that we're now, if this is the base of our triangle, and I'm just going to take this high point and I'm going to draw this down at a 90 degree to the base of our triangle. That's the base of our triangle here in this particular case, okay? So if we've got lower highs and higher lows going on, that's establishing this triangle bounce. And over the course of the last 2 times that we've seen it touch down along that lower diagonal trend line, and even back here, it has bounced from that level. But let me grab my magic marker and let's kind of talk about this. Because technical analysis suggests, conventional technical analysis, suggests that when we get an ascending triangle or a symmetrical triangle, either one, it doesn't matter, an ascending triangle or a symmetrical triangle, when we get that type of pattern, what matters is the directional trend coming into the pattern, because that influences price movement out of the pattern, okay? More often than not, and there have been statistical studies done. Unfortunately, they're contained in proprietary books, and I can't recommend those books, but you're welcome to go out and find them and look for that information about the probabilities of different price patterns and their likelihood of moving to completion and their targets and those types of things. But when we see an upward trend coming into an ascending or a symmetrical triangle, more often than not, price comes out of that triangle in an upward direction. Doesn't guarantee that. Like I said, more often than not, but that means that it can also go the opposite direction. And it can come out of that path to the downside. But at the moment, it would certainly seem that if this is the length of our pattern, right? This is the length of the pattern, and we were to take these lines kind of all the way out to their apex, and we're just kind of extend this out to the apex. I'll just kind of do that broadly. And if that were the case, then this might be the complete distance of that pattern. This area right here, between about 2/3 and 3/4 of the length of the triangle, that area right there is ripe. That is the sweet spot from a technical analysis perspective for a breakout of that triangle, either to the upside or to the downside. But once again, more often than not, when a bounce and a breakout occurs in this range right here, between 2/3 and 3/4 of the range down the triangle, it moves in the direction of the prevailing trend coming into the triangle. So the likelihood here, not a guarantee by any means, but the likelihood, given what technical analysis suggests, this is not me. This is not the gospel according to Ben Watson today. I know I sometimes do that, but the likelihood, given technical analysis perspective, is that price comes out of this target to the upside if it makes that move to the top of the triangle. Now, what changes this perspective is this. If, and technical analysis suggests this as well, that if price moves, and if we take this out to its apex, to the point of the triangle, if you will, and I talked a little bit about this earlier this week, if we get out into this range right here, and now we're kind of in this area, with that price kind of getting squeezed back and forth in between those levels of support and resistance, that tends to be exhaustive to bulls, because bulls have a tendency to wait and back off a little bit, and then bears step in and start to sell. So if we get down to the coffin corner, well, that's sometimes referred to, I know there's a lot of different reasons why different organizations or entities or ideas use that coffin corner idea. In this particular case, it's a low energy range in a symmetrical triangle. It also comes from aviation, it comes from sailing, it comes from baseball, it comes from a lot of different things. But you get down into this coffin corner, that we'll call it, into this little squeeze towards the apex of the triangle, and more often than not, the price comes out to the downside. So here we are, right at the edge of the sweet spot of that bounce and that possibility, and we get a big honkin' bounce up off of that level of support. Now, we didn't get much of a change in the RSI, so that's why we might then be looking for some kind of confirmation from momentum or an oscillating indicator. Once again, and Cameron, thanks for putting out that Advanced Charting Techniques webcast playlist there, because I know you talk about a lot of different other indicators, oscillating indicators that can help us to confirm this kind of movement through the use of momentum and other things. But the reason I'm spending so much time on this is because there has been, as we've had, these big down days over the course of the last couple of days, there's been a lot of panic. And there's been a lot of, climbing the wall of worry and worrying about this and saying, the sky is falling, it's all coming crashing down. Well, it isn't until it does. And until it does, we can't anticipate. We have to trade the reality of what we see. Now, that doesn't mean that we can't take protective activities in mind. We can't use hedging techniques and things like that. But, it is certainly something to keep in mind, that if we can avoid those panic headlines, maybe we're better off, right? That sometimes these things happen simply because of the wild madness of crowds, correct? Now, yeah, you're absolutely right, Eric. Good point. The media stokes it all with this AI bubble talk, and listen, if any of you have been to some of my live events, you've heard me say this before. And you've heard other people say this before. Once again, it's not just me. But the news media thrives on blood in the streets. People click on news stories when they think it's fearful and when they think it's blood in the streets. And so says that the market is gonna crash. Click. But trade what you see. And that's the nature of technical analysis, is it gives us a framework around which we can base decisions, not on what we fear is going to happen, but what we actually see happening. And that's the reason why we've spent some time having this particular discussion. Yeah, they love it. Those that are perma-bears love it. But just to just simply say, yeah, it's got to go down because it's too high, or it's got to go down because valuations are too high, or it's got to go down because this, because that, it doesn't got to do anything. So trade what you see, not what you think or anticipate or fear or hope or anything else. All right, let's take a look at the next one here. All right. You know what? And again, here's my point. I don't care what the ROI is on AI or what the valuations of the companies are within the AI space or anything else, because at the end of the day, what matters is what the price is doing on the chart. Period. End of story. You can have all of those stories, all of those insights, all of those thoughts that are out there, but what's going on the chart is the price movement. All right. So here's again taking a look at the S&P or the NASDAQ here, and certainly looking at monthly and weekly charts is another way to kind of put that into some perspective here. 3-year weekly chart, That's a cobra pattern at the top of an uptrend. That's a symmetrical triangle at the top of an uptrend. And again, trend coming in tends to matter. Hasn't made a new lower low yet. Let's go back to a daily chart. Let's go to the next one, and this is the NASDAQ. So NASDAQ in this particular case, if we look at these lows, these are equal lows, right? We've got roughly equal lows here across this line. Now, maybe a slightly lower low, slightly lower highs, but not enough to change the trend, right? Roughly equal. Now, that's maybe a descending triangle. You see RSI pulling back a little bit, but that's rotation. So here's the thing. You think about rotating, and this is the nature of rotation, right? I started the discussion by talking about rotation and rotating maybe out of some leaders into new leaders, but this isn't an abject abandonment of the market. And the fact that this bounced at the 50-period simple moving average at a horizontal trend line suggests that there is buying pressure here. Now, what matters next is where this price goes in the context of this triangle, because this is a descending triangle. Same kind of thing. We can get a failure out to the upside of that descending triangle. It's simply a horizontal line with sellers being able to sell or pushing down at lower and lower prices, but that becomes exhaustive to sellers. If they're selling at lower and lower prices, at some point they're going to say, no more. I'm not going to sell at those lower and lower prices, and buyers are going to step in and push price higher. So that's kind of the perspective that we bring into this discussion. If we take a look at this on a weekly chart, again, same thing. Descending triangle, a little bit of a symmetrical or a cobra type pattern up at the top of that uptrend, but not breaking the trend line. Still intact. Now, the Russell 2000 is a different story. One of these things is not like the other. One of these things maybe just isn't the same. And we've seen the impact to the small caps over the course of the last little while. And without a doubt, I think if you were to put this into context, lower highs, and if we were to put this into the perspective of those lows, lower lows. And I would argue again, this is bouncing exactly where it would expect to be. We would expect from a technical perspective for this to bounce off of that trend line. And if we were to draw horizontal support levels, that's going to come back. The idea that I always refer to when I talk about this is look left to confirm right? Look left over here where we've got previous levels of support to confirm what's happening over on the right-hand side. So the small caps, which have maybe gotten exhausted, and the other thing that the small caps are suffering from is the impact from interest rate uncertainty and potentially seeing a little bit of a bounce here. Now, from a bullish perspective, breaking above that 50-period moving average, above that trend line would perhaps be a better perspective from a bullish scenario. But it could simply move up to the top of this bullish or this downward channel over the course of the next couple of weeks and then maybe retest those lows. But the RSI is starting to pull back a little bit. So break of that RSI line, gaining some momentum back to the upside might be the bullish indication here. So small caps, a little bit more bearish. NASDAQ, not quite as bearish. S&P 500, very simply neutral at this particular point. And coming up off of those levels of support, all three of these indices bounced off of those levels of support here on a Friday afternoon. Let's take a look at volatility really quickly as we get into this discussion. We'll pop over here to the VIX grid. And the volatility of VIX, now this is why I don't think this is a panic, because the volatility of VIX, the VIX of VIX, if you will, the VVIX, the volatility of VIX has started to fall, even though volatility itself, VIX, has stayed the same. Volatility of the VIX has been falling, which suggests that there's not panic selling in stocks. There's not panic buying of protective instruments. Volatility is relatively moderate at this particular point. So we're not seeing big spike moves in the VIX. In fact, we didn't see a big spike move. We saw that bleed off very, very quickly, and it's settling back now, albeit to a higher floor. It's just slightly above its average, that 30-period average of volatility here. It's right back down into the 20 handle. And you got to think about this. We have the uncertainty of the government shutdowns being removed, that uncertainty being taken out of the market. I wrote a post the other day on LinkedIn talking about the idea that that the shutdown could lead perhaps to some of this rotation as opposed to a drop in the market and a drop in that volatility. So volatility is staying a little bit higher, but not spiking significantly higher, and certainly not spiking the way that we might expect that it would spike given the move that we saw down to the downside yesterday, especially in the NASDAQ. So not seeing that big abject panic selling going on in the VIX. One other thing that I do want to look at is, and this is something maybe to pay attention to as well. I'm going to pop over here to my single grid really quickly to take, actually, I'm going to this one, I'm going to come back and I've got this grid right here. I think I have this grid. Let's see, the VIX, the VVIX, and the MOVE index. So the MOVE index, for those of you who are familiar with fixed income, the MOVE index is like the VIX for bonds. And the volatility of bonds, so that's the blue line here, over the course of the last couple of weeks, the volatility of bonds has gone significantly higher. In fact, it's perhaps just about to the point where it's reversing. And let me just zoom in here so that we can see that. It's kind of reversing where it has been in that low. So if bonds were getting very, very into a very low volatility position, bonds now increasing in their volatility. That's the MOVE index. It's like the VIX for fixed income. And when bond volatility moves higher, that can create some uncertainty on the part of the market for stocks, because if you think about the number of investors that are chasing yield, when bond volatility increases, the likelihood of yield stability decreases. So what otherwise would be bond buyers may move into individual stocks to seek yield until bond volatility settles down again. So that can be disruptive somewhat of the market. There's the VIX. There's the VIX against the SPX. There's the VVIX and the VIX. And what I want to do is I want to pop over here really quickly to our single grid. Let's go right here, our single grid. I'm going to put the MOVE index on here, M-O-V-E. You can do this as well. It's MOVE colon GIF. And there's that MOVE index right there. I'm going to do a comparison chart really quick. I'm just going to type in COMP comparison, and I'm going to put a comparison line on here with the SPX. So when bond volatility increases, you see these spikes in bond volatility, that tends to trigger some instability in the equity market. Look at what happened to bond volatility here in April, and look at what happened to the SPX. So when bond volatility goes up, equities tend to fall a little bit. And that's the relationship, that inverse relationship that we're seeing here right now. Now, bond volatility had been moving up, perhaps breaking out. That means that we might see a little bit more instability in the market. Doesn't mean that the market is going to crash or break the trend or anything else. It just means more market volatility. So that can be a potential indicator. If we start to see that bond volatility settle down because of interest rate projections, that would in and of itself lend some stability to the equity market. Speaking of projections for bond or for interest rate movement, let's pop out here really quickly. And I've got the Fed Watch tool. Now, coming up in December, we've got the last of the 2025 Fed meetings. That's coming up in 25 days, 22 hours, 30 minutes, and 37 seconds. This is the CME Group's Fed Watch tool. Now, this is a third-party provider. Remember, all of their opinions are their own. This is not endorsed by Charles Schwab and not guaranteed or anything else as far as accuracy or anything else. So what I'm looking at here in the FedWatch tool is very simply the probabilities of another rate cut for the December meeting. So the current target rate is 3.75 to 4.0. That's where we are right now. 54% probability that it stays exactly the same. 45% probability that there is a quarter point cut in December. Now, this picture is substantially different than it was a week ago. This picture is substantially different than it was a month ago. We can do a quick comparison over here to where it was a month ago, a week ago, and a day ago. A month ago, there was a much higher probability that the Fed was going to cut, 94% probability that the Fed was going to cut in December as well. That probability then went to a week ago, a 66% probability. And you remember a week ago is when we first started to get those indications that maybe there was going to be a shutdown reversal. They were going to resolve those issues. That potential dropped a little bit. A day ago, 1 day ago, it was a coin toss, 50-50 probability between keeping the rate the same and dropping the rate a quarter point. You notice there's no probability of a rate cut out here, or excuse me, of a rate increase. But this is a 50-50 coin toss. Let's take a look at the January meeting, because we've got a January meeting just coming up across the horizon. I'm going to take that to the current percentages. Now, this information, guys, this information comes from the Fed funds futures. And I talked about this in one of my trading futures webcasts, and I did a short video on it, how to calculate the probability and what the market prices in as far as rate cut expectations. So if you want to learn about that, you can go back and look at those archives. But going out to the January meeting, remember our current rate is 3.75 to 4.0. There's a higher probability of cut in January. So it seems like December may stay the same. That probability, this change from January, from where we were a month ago to where we are now, this kind of coin toss probability now is what's inducing some of that uncertainty on the part of the bond market, because they don't know what's going to happen from the Fed. And the Fed has had Fed speakers out yesterday and today talking their trial balloons and seeing how the market reacts to those ideas and those comments. Will they raise? Will they cut? Will they leave it the same? How does the market react to what they're saying? That's why today and yesterday, one of the reasons why today and yesterday have been so volatile in the market. The Fed is testing trial balloons, and you can see that played out in this probability graph. So this could be a useful tool. It is not a guarantee. These are simply probabilities. These are by no means guarantees of what's going to happen to rates or what's going to happen to markets. Let's spend some time talking about sectors. Now that we've got that out of the way, let's pop over here. Let's change our grid to our sector grid, because now we've talked markets. Let's talk sectors, because that's the name of this particular webcast, is markets and sectors. So let's pop in here to our different sectors. And this is my overall grid. We can kind of see what's going on. I want to go through these one by one, and then I've got something for you. Energy up today. Now, why would energy be up? We had crude oil prices coming down a little bit, crude oil prices getting pressured by OPEC plus statements. But the IEA, the International Energy Agency, in the absence of the EIA, the U.S. Energy Information Agency, has suggested that maybe there's a smaller supply picture and a greater demand picture afoot that has pushed crude oil prices up just a little bit in the very, very short term, but that's also bringing some of these energy names up. And again, seeing some rotation into some of these particular names in the energy space. Let's go to the next one, which is basic materials. Let me grab basic materials here and bring that label down so that we can see it. Downward channel, we talked last week, a couple of weeks ago, about the breakdown out of that channel and then the pop back in. It transited back up to that 50-period moving average and moved back down. Thinking about basic materials, these are things that are driven by largely real estate, construction, and oil prices, because it's oil that goes into a lot of these products that are falling in the materials space, and it is moving to the downside, kind of rolling over and staying within that channel, kind of staying within, as Jimmy Buffett and Kenny Chesney say, within the navigational beacons. All right. Industrial's doing exactly the same thing, kind of rolling off the side here and continuing to move higher. Higher lows, a little bit below the 50-period moving average, staying within that channel. Industrial's just kind of motoring along, and I think likely will continue to motor along from a technical perspective as long as infrastructure is getting built out. You know what the number one performing stock in the S&P has been? Let me pop over here really quickly and we'll take a look at it. Pop over here. Let's go to our single grid. Caterpillar. Caterpillar. Why? Because you got to get gold out of the ground and you got to build stuff to power AI data centers. Caterpillar. And it's started to pull back a little bit, maybe finding a little bit of support there on that gap up and that little bit of a gap fill right there. All right, let's pop back to our sector grid. Sector grid right there, sector index grid. Let's pop back down to our individual chart sectors, materials, industrials, consumer discretionary. Now, this is an interesting one because remember, this is a read on consumer willingness to spend. Consumer discretionary still staying at a higher low relative to these other lows. The trend is still intact, even though it pulled back. And we got a pretty good dip buying activity going on right there in consumer discretionary staples. And this is the one that I think perhaps is kind of the rubber match here in terms of suggesting how the market is viewing things. If consumer staples were back up above even the 50-period moving average or above kind of this horizontal support level that's been in place for the majority of the year, my perspective from a technical analysis standpoint would be that the market is quite a bit more defensive in nature. The fact that consumer staples are staying below those levels, below the 50-period moving average, and giving us a bit of a bear flag type of perspective there, suggests that the market's not rotating to defensiveness. The market is just simply rotating to different leaders within the same spaces. Not getting defensive, not buying consumer staples, not buying the staples stocks that you think everybody's got to buy when they're defensive. This is still risk on. Healthcare, it's end of the year. As James Boyd said earlier today, everybody's paid their deductible, right, for the year. So everybody's going out and spending money on healthcare. Earnings are good. Healthcare numbers are strong, because it's end of the year, and this is a traditional seasonal. By the way, I think Cameron did a webcast on seasonality and using seasonality charts just a little while ago. But you could do that here on healthcare and see that the seasonal nature of healthcare is that it tends to be strong in the fourth quarter. And we're seeing that strength here. This maybe is where some of that leadership is rotating. Now taking a look at financials, financials still staying kind of sideways here, but dropping off. Not really a lot of dip buying in financials, i.e. circle back to my conversation about rate instability. That has some instability functions when it comes to financials. Infotech, look at that big honking green candle off of that 50-period moving average here and off of those support levels. As goes the NASDAQ, so goes Infotech roughly. Seeing that bounce pop off that line. Comm services, communication services. Listen, we've got a couple of weird things going on. You've got Disney taking a big hit on earnings because of uncertainty, and that has a big chunk to do with communication services. We'll look at Disney here in just a second. But the other thing is utilities remaining strong, even though they've seen a little bit of a pullback, i.e., rate uncertainty is coming home to roost in the utilities. They depend on rate certainty for bonding for infrastructure build out. Real estate, same thing. Mortgage application numbers, it's the fourth quarter. Who wants to move in the middle of Christmas? So mortgage numbers are typically down at this time of year. This is a typical pattern generally for real estate into the fourth quarter. So that's where we're seeing what's going into this perspective on the market as a whole. A couple of individual stocks. Let's take a look. I'm going to pop back over here once again to our single grid, and we'll take a look. So right here, I moved some of these around. So there's our single grid. Thank you, Cameron, for popping that in there. I appreciate that. Let's take a look at this one. Disney. Disney on their earnings announcement actually got an upgrade today on a couple of analysts saying, hey, this was overdone. They got taken out behind the woodshed and punished pretty hard. So that push to the downside, overdone. Oh, and by the way, I will remind you, for those of you that are joining us for our in-person events, we've got a market drive coming up in Anaheim the Saturday before Thanksgiving, which means I'm going to spend a little time at Disneyland at the Mother Park after that market drive event. So their earnings might go up a little bit, at least from my efforts. I don't know that that's going to move the stock price at all, but it's going to certainly move my bank account in the downside for just a little while. But that's okay. It's Disney, and I'm good with that. But still seeing that downward movement here, seeing this break to the downside. All right, one last thing, or two last things here before we go. I know we've got just a couple of minutes left to go in this discussion. I wanted to look at this GE Verona. And looking at GE Verona, in the industrial space, this is their energy production division, the spinoff. Looking at that bounce here off of that level of support, that's a close above the high of the low day in this context. And so coming in and right-clicking and going buy custom with a stop. And we're going to put in an order here to buy this. And I'm going to make this up. It's currently sitting at 579. I'm going to make that order limit at 580. And we're going to make that stop just below that line. I'm going to make that 531 below that level there. Whoops, I'm sorry. Let's see where it is. 539. We'll make that 539 just so that's not on a big round number. 539 is going to be our stop. Now remember, a stop doesn't guarantee at what price you're going to get filled. It just guarantees the activation price. So we're going to click on confirm and send. We're going to read through this order. I'm going to put it in our market movers group so we can pay attention to that. Click on send. We'll fire that order off. And we got in at 579.07 on this close above the high of the low day. Now, it is National Direct to Consumer Friday. It is 2 weeks before Black Friday exactly. So it is National Direct to Consumer Day. So I put together a list of direct to consumer stocks that have been moving somewhat. So I want to go run through these really quickly here. Warby Parker up in the top left corner, the darling when it comes to one of the OG direct-to-consumer stocks, sales stocks, has pulled back over the course of the last couple of months into this little bit of a bounce off of that last earnings announcement, but has been wallowing a little bit. But I'll tell you what, if you notice your Instagram and your TikTok feeds and all of the ads that are popping up, they're all these direct-to-consumer stocks. So now is their time, perhaps, to shine. Allbird, when it comes to the footwear space, still seeing that move to the downside. Big miss on this last earnings announcement and a move to the downside and continuation. Chewy, maybe starting to see a little bit of a bounce. Big miss on the earnings announcement, rallied up a little bit, starting perhaps to bounce here. Peloton has struggled for a while, but it's got a higher low coming off of that earnings announcement. Hims in the quasi-healthcare space, but direct-to-consumer sales space, some strong downward momentum here. And it makes you wonder what would get this to perhaps rise. And then Stitch Fix over on the right-hand side, bottom right corner. Stitch Fix coming off of their earnings announcement, gap to the downside on the earnings announcement, but starting to see a little bit of a higher low in those direct-to-consumer stocks. Guys, it has been a great week. It's been a fun and interesting week. Of course, it always is when the market moves around. Slow markets are boring markets. Fast markets, volatile markets, those are fun. Doesn't mean you can't lose money, because you can. But if you want to learn a little bit more about all of these things that we talked about, come on over here to Trader Talk, the Trader Talks webcast page. Click on subscribe if you haven't already, and join us in our live event. Still room to come to Anaheim. That's coming up in a week from tomorrow. We're going to be in Anaheim. Then we're going to be in Houston. Then we're going to be in Miami, then Dallas, and then Seattle, and all over the place. Guys, have a great weekend. My thanks to Cameron May for helping out, and our great production staff for bringing this webcast to you, and our great reviewers. Have a great weekend, everybody. Be safe, and we'll see you soon. Take care. Bye-bye.